Good morning, everybody, and welcome to this edition of our Weekly Think Tank for Monday, 12th of April. My name is Carl Kaplingwa. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we delve into everything big that happened last week and have a look to the week ahead. Before we do, the Think Markets difference, which is substantial, $8 flat rate trades, your own holder identification number, unlimited phone support, of course, no hidden platform or subscription fees, 4 fantastic reasons to make sure your next ASX share trade is with us. And for a limited time, you'll also get your first 5 trades for free when you switch to us. New accounts only. Few terms and conditions, of course. Click on the link and you can read all about them, but I reckon that's now 9 reasons why your next ASX share trade should be with us. The agenda for this morning is to check out the market moves from last week, see what's going on the COVID front, check out all the key macroeconomic data from last week, see what the brokers are saying about local stocks, see where the value is in the Australian market, see what's going on the technical analysis side of things as well, and then have a look to the week ahead. But first, the week that was, and 3 things stand out for me here. The first is all of the green on the screen, apart from, of course, the ASX Volatility Index, which fell about 13%. We can count that one as a green, really, because it's good when volatility is falling. It means investors are calmer about their situations. But of course, it also means that all of the key ASX sectors were higher. Now, the other couple of things that struck me on this screen is the significant outperformance of a couple of sectors. So firstly, the gold sector, best performer last week, huge bounce back, about 12%. And that's in response to about a 4% rally in the gold price. So it's showing you there is some leverage there to the gold price within that gold sector. And information technology up about 10%. That's in response to a bit of a rally in the NASDAQ, and more broadly speaking, a move back into some of those growth plays. So as we know, more recently, we've seen a big decline in growth stocks compared to value and cyclical stocks, part of this reopening. And part of also, I think probably more importantly, is the rise in interest rates. And rising interest rates hurt growth stocks with earnings further out than they do value and cyclical stocks, which are expected to see earnings very, very soon. So I think 2 really important moves there to keep an eye on. I do think both of those sectors have turned the corner, and I think now you can switch from previously what I would have called sector avoids to sector accumulates to start to find some of the best looking stocks in those sectors. I'll talk about a couple when we get to the end of this presentation. Okay, the rest of them did quite well. Also, materials, I think that's important. That's one of those cyclical sectors. It has been a little bit weaker lately as a rise in the US dollar has crimped some of those commodity prices. But that's also, I think, an important bounce back. Other than that, very good performance across the rest of those sectors. It is all about bond yields at the moment. We did see bond yields pop back up a little bit on Friday, but more broadly for the week they were lower. You can see 4 out of the last 5 candles down there, and back to the bottom of the range around that sort of 1.65 level. Certainly a little bit easier for markets to deal with that than up around those highs around the 2% level. And it's not like a stock here. It's not like if we break down, we go back to 1% and lower. And we don't want to see that, because if we went lower, if we went back to 1%, I should say, it would mean there's something very, very wrong in the world. But don't forget, bonds are more of a flight to safety asset. You buy bonds in times of uncertainty. So yes, we want interest rates to be low because it facilitates high share prices, high valuations in the market. It helps those growth stocks. It also helps the global economy. But we don't want them to go too low, because it would be an indication that something very sinister is going on. So yeah, look, if they came back to 1.5%, or even if they held around that 1.6%, I think it would just take the edge of some of the news about that recent shoot up in those yields. So just trying to put things into perspective for you on this Monday morning. Also putting things into perspective, I think the best way to do it is to look at the overall index, and we've got the ASX 200 here, and we can see we've got 1, 2, 3, 4, 5 out of the last 6 candles up. We saw how good it was for those sectors. But it's all looking pretty great here on the chart. So we have had a move through that 69.38 level. That was a very pesky level that we were struggling to get through. And before that, we had a move through this 68.61 level, which had capped us for a good month or so. More broadly, this range has been the bane of investors' existence for a good 4 or 5 months now. So it's great to see us moving through the top of that range. What it does is it draws a lot of investors who are quite simply just waiting for the range to break into the market. So there's lots of cash on the sidelines waiting for this breakout. That cash now needs to get put to work, and it doesn't get put to work all in one day. That's just silly. It'll take time to come in, and that's why we see when we do have breakouts of ranges that the price tends to continue to go up for a period of time. So it wouldn't surprise me if we went up this week and tried that 7197 level. There might be some supply at that point, just from people taking profits, if anything. But if we had a very small, shallow pullback from there, I think it does set us up for a move through those highs and to make new all-time highs. And who would have thought, with a global pandemic behind us, that we would be saying that so quickly. So overall, very, very constructive for the ASX 200. Short-term uptrend, long-term uptrend, very much in place. Having a look around the world, pretty quiet there for Asia. Nikkei and the Shanghai down a touch, Hang Seng up a little, but the US was the key focus. So we saw the Dow Jones rise 2%, an even bigger rise in the S&P 500, far more growth stocks in the S&P 500 than the Dow Jones, and far more growth stocks again in the NASDAQ composite, which is a growth-oriented sort of index, up 3%. So it's starting to give you an idea, along with our move in technology, where that money is starting to slosh around to. Volatility down about 4%. That's always very good. I've got a chart of the volatility index coming up for you. And then some good gains in Europe as well. As promised, here's the volatility index, and we can see a breakthrough, a pretty key level. It was holding around that sort of 20 level for quite a long period of time. We've actually broken through it now. We got as low as about 16.5, and the important thing here, this represents the level of skittishness in the market, the level of anxiety and nerves. So anxiety, nerves, skittishness on the way down. That's a good sign for markets, because it means investors are more confident in this situation. They're more likely to put cash to work, and prices are therefore to rise. And the significance of the level, so 16.5, is still pretty high by historical standards. So the best bits of the bull market, so the best bits of the increase in the S&P 500, this is the US volatility index, occurred when this VIX was below 15, but more specifically around that sort of 10 level. So the 2017 low point, about 8.5, about 8.9 in 2018, and about 11 for 1920. So there's still a long way to go, is the message here for the VIX, and therefore there's potentially a long way to go for the market to the upside. Having a look at that S&P 500, we can see it is looking a little bit like the stairway to heaven here, and this was their pre-COVID high. So just to put it into perspective, how far behind the Australian market is in comparison in relative price performance. So, to put it into perspective, we're kind of around about here, eyeing off that all-time high. And I'm not going to say that if we do break the highs, then this bit is what we've got in front of us. But this does give us an example of how markets can respond once they do break out through those highs. And it hasn't all been plain sailing too, mind you. But where are we now? We're looking pretty good. Lots of white candles in the system, telling us that regardless of whether we have a higher open or a lower open, whether there was anxiety overnight or not, markets by the end of the session are closing higher. And that is just evidence of that cash being put to work. Not just obviously here, we're starting to see it here, but in overseas markets as well. And I think the US market is well placed to outperform other global markets at this point in time. Look, a little bit's been said about the lack of volume in this move, and don't worry, I've noticed it also. I don't look at that with a lot of concern. I think it is more of a sign of a lack of supply in the market than anything more sinister. So I think we do have demand, that's clear. You can see it in the candles, and the falling volume is just demonstrating that people who are in stocks, people are holding the stock. Now, if you're going to buy stocks, you need to buy them off someone. It's showing the reluctance of the other side to sell those stocks unless they're getting higher prices. So I think that's quite constructive as well. When you see the volume come in, that's telling you that, wait a minute, there is supply in the market. People are prepared to sell now. They're prepared to supply stocks into that demand. So that's something I would be more concerned about. Okay, having a look to the commodities markets here, some nice gains in the base metals. Looks like steel was really the only one that missed out, but not by a whole lot there. Nice gains in aluminium, nickel. Good to see that one bouncing back. Zinc also doing pretty well, and obviously for the local market, iron ore up 4% in the US. Gold, as we mentioned earlier, had a little bit of a bounce. Not as much of a bounce as the gold sector, but starting to firm up there on the technicals, a bit of a double bottom pattern forming. Oil had a tougher week there, down about 3%. Chart's gone a bit flat. I don't think it's anything too sinister at this stage. The Australian dollar up slightly as the US dollar index more broadly fell, and it does show some underperformance there in the Australian dollar. That's quite interesting, and bond yields were down. We talked about that earlier on. We mentioned that double bottom in the gold price. Here's a chart of gold, and we can see 1676 and 1677. There's some nice candles off there. You look at how the market bounced off that level with those strong candles. That's indicating that there are funds out there watching that zone, looking to stamp out a low here. I do now think there's a pretty strong signal from the chart that there is demand in the market down here. How long that demand lasts for and whether there's enough legs in it to push it through other key resistance levels is still unknown, but I think it's a good first sign. So I think you can start to take a little bit of a nibble in the gold sector. I'll show you a chart on the next slide of one you might want to look at, but it's just a nibble at this stage because the gold chart trend is still down. So a little bit of caution, but maybe get some capital to work. And as promised, the stock pick for the gold sector is Ramelius Resources. So quite an interesting little company, putting aside the chart for 1 second. Very low cost producer, actually produced at a lower cost than Newcrest Mining. Growing production profile. They keep beating their output expectations. Fantastic free cash flows, really just a cash cow at the moment. And that should help their dividend yield along, which is about 2% at the moment. But just a really well-run business. In terms of the chart, though, it's starting to look quite interesting. Obviously, it's had a big hit on the back of those falling gold prices, and equally, as I said, lots of leverage in the sector at the moment, a nice rally. But whereas we saw the gold chart double bottom with similar bottoms around here, we've seen a much higher bottom on the Ramelius chart, and a very strong performance through the week there to actually take it above this long-term resistance zone. So that's the still currently an uptrend technically, but obviously as it's orange and narrowing under threat. But the fact that it is above that zone I think is very positive. We should see that zone go from offering resistance, as it has done here, into support. So I think that will be the demand zone. Now, so that you can buy it around that sort of 165 level. If you wanted to get it around 170, I don't think that's too bad either. But you've probably got a little bit of time to start to accumulate. So as I said, we're going from a sector avoid to a sector accumulate, targeting the strongest stocks in the sector. I think Ramelius is definitely one of them. I talked about the information technology sector as well and how well that had done. I talked about this potential move back to growth. I said the sector is also going from an avoid to an accumulate. There are lots of big picks out there. I wanted to talk about the one that I think has the best trend at the moment. It's this one here called Dropsuite. And these guys do cloud backups for business. They've got customers all over the world, about 430,000 of them. They're growing those customers very quickly. You're looking at about a 50% increase for 2020 alone. Recurring revenues up about 68% for that period. Not making money yet, but they're very close to doing that. They should go cash flow positive either this quarter or the next. And that's generally when I and many analysts like to look at them, where the cash starts to turn positive and they're on the pathway to making some profits. If they do what I think they should, they're not looking too expensive around the current sort of market capitalization, which is around about 120 million. Chart looks fantastic. Bottom left, top right, it is speaking to how well management is executing and to the growth in this business. Happy to buy it around current levels. If you got it around that sort of 20, that would, I think, be a very good price indeed. Short-term trend, long-term trend, exemplary, and the price action, high peaks, high troughs, looks very good as well. So a couple of stock picks for you here on Monday morning. Okay, this is an interesting chart. We do like to look at this one. It's a little bit of fun, so don't take it too seriously, but it's how the current move, the current rally in stocks, so this is the S&P 500 this time around in the pandemic, compares to how it went in the GFC. And we noted a couple of weeks ago in our last update that we're kind of getting pretty close to this rally point here, where last time stocks really took off, and we speculated that it's kind of looking the same and it could happen again, and lo and behold, here we are. It's looking almost identical. Okay, what does that mean? Well, it means potentially there's still a bit of upside until we get to this high point, but then you have to question mark what's going to happen over here. Now, there's no reason why these two charts should look the same. They just do. And as I said, it's a bit of fun, so let's keep moving. Having a look at the COVID picture, we are seeing the situation get better in Europe. It is roughly steady there in the US, isn't it? And Brazil, it continues to get worse, and the standout there clearly is India. So I just wanted to show India and Brazil. So, still hard to control the virus in those countries, but if you look at the more sort of Western countries, it's getting more and more under control. Germany, although, having said that, a little bit of a tick up there. So I think the message is, look, we're not out of the woods yet, but similarly, it's not a huge market moving factor just right now. Okay, having a look at some of the economic data from during the week, Australian job ads, we saw a 7.4% increase, a little bit down on the previous month's gain of 8.8%, but still, very firmly set in the positive territory here. And at 190 odd thousand jobs created for the month, that is sitting around the best level since November 2008 and up about 40% from this time a year ago. So that's pretty handy for the Australian economy. And also handy for the Australian economy was the Reserve Bank reiterating their commitment to keeping rates low for an extended period of time. They said that whilst significant progress has been made by the Australian economy, there's still a long way to go to repair the current situation, and that as a result of that, they would continue with their bond buying purchases. They would continue with targeting shorter term rates at close to zero, and more broadly speaking, supporting this economic recovery. Having a look at some of the data in China there, and a couple of reads on inflation. It is all about inflation at the moment. That's why interest rates spiked, and that's why markets had their wobbles. And as is so often the case, markets are anticipating these things, and markets are anticipating higher inflation ahead. And there was absolutely no sign of inflation in the system, really in any country, when interest rates suddenly took a spike. But it's starting to appear. As we can see here, the Chinese Producer Price Index, after a significant period of deflation, has now moved significantly to the upside. We saw a 4.4% annualized print that compares to the 3.6% markets were expecting. So worse than expected and well ahead of that previous 1.7 level. That's where the biggest gains were, but also a move up in the Consumer Price Index to 0.4%. Nothing to get too concerned about yet, but if this is anything to go by, then we could see a big move up in consumer inflation in the not too distant future. And certainly a lot of the surveys suggested that some of the businesses are feeling more comfortable in passing those price increases on to consumers. Okay, and we know that central banks are targeting inflation. They're trying to get inflation back up. So a bit of a rise in inflation is not a bad thing, but we don't want to see it overshoot what the central banks want. That could mean higher interest rates and lower share prices down the track. So we need to watch these numbers very closely. In the US, similar data here, Producer Price Index, again, way ahead of expectations. So we saw a 0.7% blip up in the core, way ahead of the 0.2% markets were expecting, and way ahead of the 0.2% we saw previously. Yes, there are some supply side constraints contributing to some of these moves up in businesses. They should normalise over time, tempering some of this inflation. But at this point in time, businesses are finding that their input prices are increasing, and again, talking about passing those price increases onto consumers. Other data out during the week in the US, we did see 744,000 weekly claims for unemployment. It was higher than the 682,000 expected. And that, again, just speaks to the damage still done in the US economy and reaffirms why central banks are remaining so accommodative at this stage. We did see a continued fall on those continuing claims. So these are, with the green bars are the new claims, the red line is the continuing claims, and that's the lowest level since the pandemic begun, but there are still about 7 or 8 million more Americans unemployed now than there were before the start of the pandemic. So a long way to go to repair that US economy, and certainly before you start to get any wages growth that could feed into inflation. Okay, having a look at what the brokers said about the Australian stocks from last week. They're literally only one upgrade and downgrade from the week. Macquarie upgraded Resolute Mining. The company came out and reaffirmed some of their resource estimates and production targets. So Macquarie popping the price up there by about 11%. Not a lot left in it, I think, from Macquarie's point of view, only about 4% left to target and retained a neutral rating. And then Citigroup downgraded BlueScope from a buy to neutral, I should say underperformed to neutral at Macquarie for Resolute, but buy to neutral for Citigroup. And the commentary there was that BlueScope is going gangbusters. So the downgrade looks bad, but the company's doing so well, according to Citigroup. But the share price has also done very well, and therefore they're not seeing as much value in the company as they saw before. They did increase their price target by 7%, and there's a little bit left in it, but you can see with only 3.7% upside to their target, a good reason, I guess, to go to neutral. Have a look at the top 10. So these are the top 10 price rises in the top table and the top 10 price decreases from brokers in the bottom table. Ainsworth Gaming Technology getting bumped up 16.7%, but still at a sell at UBS. UBS said that the company is still suffering in Latin America, a little bit less in North America and Australia. There's some recovery there, but certainly no reason to change their rating on the stock, but happy to upgrade the price a little bit. The company is still overvalued as far as UBS is concerned. You can see there 53% downside to their target. We've talked about Resolute Mining. South 32, they had an update on their South African coal divestment plan. Brokers like that one. Sims Group, I think just ebb and flow there, nothing too interesting. EML Payments announced an acquisition, so got a little bit of attention from the brokers, which generally liked that acquisition, and they go on from there. Western Areas, I didn't actually catch the news on that one, but there was some news, so apologies for not keeping up on that one, but it's a 20% decrease in the price target from Morgan Stanley, but retaining their overweight rating. Curious, given that they see only 5% upside to their price target. Some news out on from Net Wealth, correct me if I'm wrong here, and it's hard to know what happened on every stock on the market, but I'm pretty sure they announced that they were losing some interest on some of their deposits, and in a business like that, that can be a substantial hit to their earnings. So Credit Suisse dropping their price target by about 17%. UBS has reduced its expectations for iron ore prices in 2021 and 2022, and hence the reason for a big downgrade there in the price target from Rio Tinto, 126 down to 104, and a neutral rating on them. Nickel mines, there's Citigroup saying there's been a bit of a tectonic shift in the nickel market. So Tsingshan nickel miner, operations based in Indonesia, so I do pay attention to a lot of these company announcements, they announced a little while ago that they had cracked the Da Vinci Code, really, to turn low-grade nickel into high-grade battery nickel. And Citigroup basically ran the ruler over that change in the market and said, look, increased supply for higher grade nickel. They can't see a huge increase in demand to match that, and therefore prices for nickel would likely remain subdued, and that would have a negative impact on nickel mines. So they downgraded the price target by about 12%, retained neutral. JP Morgan commenting on the imminent departure of the AMP CEO there, and downgrading the price target. Ebb and flow, we've talked about, or rather not talked about, Western Areas, and they go on from there. I'll let you press pause and read those. But as always, lots going on the broker side of things. Where is the value in the Australian market at this point in time? Well, the average P at about 18.74 is better than the world PE of 20.48, but hardly screaming cheap at the moment. but I guess we're less expensive than the rest of the world. Having a look at the sectors, I think materials at 11.5 and actually cheaper than where it was a month ago. I think that still looks really good. We saw them outperform last week with that 4% gain. Base metals prices were up, and particularly iron ore. So I think the material sector is a really interesting sector to look at the moment. Oz Minerals would be one of my strongest picks there. We've talked about Remedios. I guess the gold miner De Grey also looks pretty interesting. Mineral Resources, ticker code MIN, looks pretty good as well. Next up from there would be, what's the next one? Financials, I'm guessing. Well, not quite energy. So energy is probably the next cheapest, and then financials, and then they fall away from there with information technology. Clearly still the most expensive sector, but hey, it's a growth sector, so those PEs are going to be high. With them now around about 50, a little bit better than where they were. I think they got up to pretty close to 80 not that long ago. So if you could call that a little bit of a bargain. Having a look at the technicals here. So what we're checking here is the performance of the ASX 300 stocks versus their respective moving averages. So we can see we've got how they're trading against their 5-period moving average, 10-period moving average, that's 2 weeks. 21-period moving average is a month. Don't forget to take out weekends and public holidays. That's how many trading periods there are in a month, and then extrapolating that out all the way to 12 months. And we can see that almost 80% of stocks are trading above pretty much all of those moving averages. So, between 80 for the shorter term ones and about 70, 75 really for those longer term ones. Now, that is the best that we've seen in our weekly think tanks. It is certainly the best we've had since the pre-COVID highs, which is the green line. So we are now better on our market breadth, on the number of stocks participating in the current rally than where we were at our record highs. How about that? We are in a better position than our record highs. So this is a really, really strong signal of participation in this rally, of investors really putting their cash to work. And I think it bodes well for our local market going forwards. Okay, what's coming up this week? It's actually very, very busy this week here and abroad with NAB Business Confidence Survey, Westpac Consumer Sentiments, inflation expectations there from the Melbourne Institute, and then the big one coming out on Thursday, which is our local employment data. We're expecting that the unemployment rate should drop to about 5.7% and about 35,000 jobs will be created, or were created, I should say, in the last month. Having a look abroad, we've got retail sales in Europe, we've got M2 money supply, new loans, trade balance in China. We do have some bond auctions, which usually you wouldn't even blink at those, but given the current situation with interest rates, it'll be interesting to see how those get away. There's a 10-year and a 30-year one there in the US. We have CPIs, so consumer inflation. We saw a big pop up there in the PPIs. We're expecting the CPI to come in at about 0.5%. That's up from the previous 0.4%. So watch for a shoot to the upside there, and 0.2% on the core. I think it probably will come in a bit higher than that, given those PPIs. Heading into sort of Thursday here, US retail sales, Philly Fed manufacturing, weekly unemployment claims, Empire State, industrial production, business inventories, the NAHB Housing Market Index, Chinese GDP. It is going to be a massive week. As you can see, fixed asset investment, industrial production for China, retail sales, unemployment in China. Massive data dump here on Friday our time, and then some more inflation there in Europe, and finishing off the week with the some building permits, housing permits in the US, and then the University of Michigan Consumer Sentiment Survey. Wow, deep breath. Thanks for sticking with me today. I know we've gone a bit longer than we usually do, but hey, what a week it was, and what a week it could be. You can catch all of our other market updates in our market news section of the website. You can follow me or the Think Markets handles on Twitter if you like, and you must head to the webinar page, but you must head to the webinar page and register for our upcoming webinars. Top 3 ASX turnaround stocks. We saw Remedios there. I think that would certainly fit into that category, but tune in on the 21st of April to find out 3 more. Ask the experts, where you get to bring your portfolio to the table, and ask me for some quick analysis. And then we've got our fundamental analysis refresher on the 5th of May, and I think it's a perfect time to brush up on our fundamental analysis skills. The disclaimer before I leave you today says that everything we've discussed is general in nature. We do have some products as a regulated Australian broker that could see you lose more than your deposit. So please read this disclaimer carefully, or if you have any questions at all, give us a call. Thanks for joining me this morning. Hopefully you got lots out of it. All the best for your trading. Until we catch up again. Bye-bye for now.